thank you very much for that rousing round of applause. That was good. Now this is I think it's my 6th talk in 4 cities over the last 6 days. So I'm gonna try to have a little bit of energy here today, but if I start fading, somebody just yell and maybe tap me on the head. But I was in New York to start the week. Then we were in Toronto. We went through Vegas, and now we're back here in Vancouver. I do live here, so I'm glad to be home. Still haven't seen my family yet, so it'd be nice to be able to see them. Now, this is the point on my slideshow here where it says insert something funny. I got nothing for you, I'm sorry. I'm gonna try to put a little humor in later, but we don't have much right now. Now, if you don't know what Keystone does, we are an independent research firm, been around for 20 years now. This should not make us different in the Canadian markets, but it does, and I'll tell you why. We don't do any financings for the companies that we recommend, like a big bank or a brokerage would. We don't conduct any activity with the companies that we recommend. That would introduce a bias into our research. Of course, we don't receive any money for including a company within our research. The only way we get paid is by our individual and institutional clients across Canada and now into the US who pay us to find them 10 to 25 stocks to build a portfolio over a year to 2-year period. So all we do is do a ton of research to recommend. We go through all 3,500 companies, for example, in Canada twice a year just to find you 8 to 10 stocks on an annual basis. The title's a little provocative about what I'm going to talk about today. It kind of is more bark than bite in this sector. We did recommend 5 companies here last year, and it's not that we avoid technology or avoid the next greatest trend. We just have to pair that with good solid cash flow. Now this is the company. Why should you listen to me? Why should you listen to Keystone about, or for use Keystone for their advice on what stocks to buy in the market? Well, we stick our neck out at conferences like this all the time. Last year we recommended 5 stocks, and you can see how they have performed over that period. Now there is some tech angles to these companies and some future or extraordinary type future angles to this. Questor is a clean tech company, revolutionizing the way that gas is flared off at the wellhead in the energy sector, clearing 99.9% of the noxious fumes that come off the wellhead. So it's done tremendously well. I mean, it's really about the returns in our market. You can see Questor is up 102%. The only laggard of these 5 stocks is a company I will recommend again today, Sylogist. It is a SaaS company, and we'll get into that business. But of the 5, the average gain is 50.22% over the past year. Now, the S&P TSX 3 Composite Index is up around 4% over that period. So these stocks have went up over 50%, whereas the index is up 4%. These are all small cap companies, so it's better to compare these companies to the Russell 2000, which would be your small cap North American index. That index is actually down 7% over the last 52 weeks or the last year. So down 7% if you would have invested in that index. If you would have used our growth at a reasonable price strategy or our research, with these 5 stocks, you'd be up on average 50.22%. Now, like I said, proof is in the results. All of these companies that we recommended here for our clients have been recommended at significantly lower prices. For example, if you look at Expel Inc., it was recommended this time last year at $1.42 to our clients. It sat there for about 6 months in the $1.50 to $1.25 range. Came out with absolutely blowout quarterly results at the start of 2018. Stock went to $3. We reiterated our buy at that point on the stock. If you can imagine, or if you can understand the concept, it was actually a cheaper stock on a cash flow basis because of how great their quarter was at $3 than it was at $1.50, because we could project that cash flow going forward. We've subsequently, again, at the start of this year, recommended it at $5. It says right there it's trading at about $11.02. I think it crested $12 today in that range. So it's performing extremely well. Boyd is on here. Boyd is a company we recommended 11 years ago this month at $2.30. So people always say, you recommended it again last year at $120. Why the heck would you recommend a company that you recommended at $2.30 again at $128? Because every time we look at a company for an update for our clients, you want to look at that business with fresh eyes and say, would you want to employ your capital in that again? At $128, we still wanted to employ capital. Trades today at $180. Tremendous performance over the past year. Boyd is one of the best performing stocks, and we'll get into that in a second on the TSX. Now, what is common to all of these companies? All produce tremendous cash flow. It's traded at reasonable valuations. But I would ask you too, you don't hear often about these companies on BNN, or many of your big bank advisors are not going to recommend these companies to you. So why is that? Why aren't these stocks in your portfolio? Hopefully, if you're a client of ours, some of these are in your portfolio, but for the average investor, why don't these type of companies make it into the portfolio across Canada of many Canadians? Well, perhaps most importantly, these aren't the sexiest stories out there. They require very little outside capital, or if they require capital or funds to be raised, they can do it at very favorable terms because they have excellent underlying businesses. You see little coverage from these companies. Banks see little coverage on them because of the fact that they don't need money often. They are free cash flow generating. They're self-funded. And I'll let you in on a little secret. Bay and Wall Street cover companies that need capital. These companies don't need capital. They're kind of flying under the radar. We love those good, solid businesses that do that. And we like to recommend to our clients. So instead, what do you find recommended to you? Often you see in Canada, lately it's been cannabis stocks, energy, mining, and concept stocks. You can note those 5 companies that we talked about, none of them come from those sectors. You got a vast array of industries that we look at, but if we can't find cash flow and growth at a reasonable price, we won't recommend it to our clients. Those companies came from auto repair, healthcare, technology, clean tech, so a variety of sectors. All of them producing services that the world needs and products that the world needs. Simple businesses that we can understand and value. Now, not only did we recommend those 5 stocks, but we also put out a call to avoid everything in the cannabis sector this time last year. Now, that's not because I have anything against cannabis or the product or anything like that. I'm a slave to cash flow. All we do is look at the underlying businesses, and these businesses were not making the cash flow at the time necessary for them to fit into our box and recommend to our clients. Now, the other thing we saw in the industry is we did work on all of these companies. We took 2.5 months, put a couple analysts in our firm on them. They analyzed, there was over 120 companies in the cannabis sector this time last year. There's more now. Some of them are consolidating at this point though, but we looked at everyone, looked at the MD&A, management discussion, the financial statements of all of these businesses. We couldn't find one that produced solid cash flow. We also did numbers on the sector generally speaking. The top 10 producers had productive capacity that was over two times the expected demand in the near term for that segment. So what that says to me as a general industry is when you have overcapacity potentially and supply concerns as well as you get a situation essentially where you can have reduced margins over time. That is not an industry we want to be involved with. We may buy a cannabis company in a year, a month, 2 years from now when we can find some good solid value, but we're not there right now, and we won't go outside of the box that we look at for our clients just to find an industry that is high growth. We can find little interesting businesses like the 5 we recommended this time last year and a couple I'll talk about today that have a better risk to reward profile. So how did that call go this time last year to avoid everything in the cannabis sector? Well, let's take a look. The biggest name in this country and perhaps the world in cannabis was Canopy. How well has the stock done over the past year, this time last year to today? It's down 43%. Now, Tilray, much hyped company at this time last year. an absolute destruction of capital over the past year in this business. If you would have invested in this company, you would have been down 85% over the past year. The Green Organic Dutchman, down 70%. To be honest, I could go on in this sector. There's been, like I said, a complete destruction of capital. That doesn't mean we can't find a company going forward, but right now, we don't see value. But why are these companies sold to you? And I alluded to this earlier. Again, I let you in on that secret. Financial companies and public markets in this country and across North America are really set up, especially in the venture area of the market, as stories or ventures. And I use those words because we don't really describe them as businesses at this point, particularly if you look at the resource sector in this country. They can sell these stories to you, but that doesn't mean they're good investments. Many big bank brokerages will raise their money this way, and that's where they make their money. They don't make their money off making recommendations to you in your portfolio. These are sexy stories that they can sell to you, but as you can see, if you're buying over the past year, it would have been a destruction of capital in your portfolio. The same thing we saw. I believe that blockchain is a tremendous technology, and I've had an analyst do a ton of work on this sector. We looked at, there was this time last year, 38 companies that were publicly listed in that segment. We couldn't find one that had more than, or there's only two, sorry, that had more than 300,000 in sales on a quarterly basis at that point. So really, businesses that were completely unprofitable. What were they? They were just companies that had put blockchain in their name because it was a sexy sector to raise money in at the end of 2017 and into 2018. We wanted to buy something in that segment, couldn't find value there, and recommended again in 2008 to completely avoid all public companies that were trading in the blockchain or cryptocurrency sector. Of those 38 companies, we tracked them over 2018, the average loss was 82%. So it's a cautionary tale to not follow the herd and go into these overhyped segments. We may at some point, there's some companies that we also recommend, larger companies. I'm going to talk about some small cap companies that we recommend today. We may find companies that apply blockchain technology. There's a company in the US that we recommend at the start of this year, EPAM, symbol is EPAM, that has a blockchain element to it, but it's a great profitable business that is just using that technology within their business. So that's how we will apply and kind of glam onto a hot theme over the long term. But we won't just buy Global Blockchain Inc. because it has that in the name or it's a symbol that is associated with that sector. That is a way to part with your capital very fast. So what do we suggest you do in your portfolio? Again, and I alluded to this, avoid the hype and focus on great cash flowing businesses. That is how you will make returns long term. Do not buy the market. Right now, we think the markets on a general valuation basis are expensive, but we can find little solid values in the market that are undervalued. So there's little anomalies, that's where we want to put our capital. So we want to buy those quality individual stocks to make your returns over the long term. So if you want to beat the market, you can't be the market. We gave a class earlier this week in Toronto, and it was all about how to structure your portfolio. We don't want you to buy 100 or 50 stocks because you've just bought the market, and what you'll do is underperform because the fees you buy to either buy those through an ETF or a mutual fund, or if you bought them individually. You don't want to buy 2 or 3 individual stocks because you got too much company-specific risk. What you want to do is have a sweet spot of between 10 to 25 stocks, and we'll get into that in a second. Now, since I was here last time, I'm going to make this light for a second here. I was here this time last year. There's a lot that has happened. There's always noise going on in the markets, and we like to show when I give presentations all the noise that you probably don't really need to pay attention to. You want to pay attention to good, solid businesses. But there were some big announcements, and we already talked about this, but this time last year, in this range, well, of course, cannabis was legalized. Now, I did this in Toronto, and I was a little worried, but the room had a big laugh on it too. I've heard there was a scandal involving this gentleman recently, so everybody's having a big laugh at him right now. But I love internet memes, and I love to use that in here. So there was also a lot of people over the last year and a half that made some money in Bitcoin. Now, some of them then subsequently lost that money and then started to gain it back at the start of the year. But suffice it to say, we found out that trading in cryptocurrencies is not for the faint of heart. And I would agree with that. You want to do that yourself. I can't analyze. We can analyze a lot of businesses. We can't analyze Bitcoin. I can see some use cases for sure for it, but it's not something that we'd be recommending to our clients. It's completely outside of the box that we cover, but it provides good fodder for a few laughs right now. Now, our point is, with all this noise going on in the market every year, our message remains very consistent over time, and I think what allows us to focus on what we do best. We just want you to buy, and I'm going to hit you over the head with this a lot, cash-producing businesses with a focus on long-term growth that'll help you beat the market. Now, again, these are often not the sexiest stories on the street, but in most cases, I can value them, analysts at Keystone can value them, and that's very important when you've bought a stock to be able to know how to value that business when you own it and continue to own it over time. Now, I'm going to ask for a little audience participation here. Whoops, I went too far. I think I just gave away that one. I hope you all know that anyways, but now I'm going to ask for some audience participation right here, for the love of God. Does anybody know the best performing stock on the TSX over the past 11 years? Come on, somebody. Right there, very good. You know, I did the same thing this time last year in Toronto. There's 500 people in the room, not a single person. Somebody said Canopy, which it did perform well at that point over the, but it wasn't close in terms of return. But yeah, it is Boyd, of course. And the reason why we point this out is you couldn't have a less sexy business than this. What does Boyd do? They fix automobiles. They own automobile repair shops. I'm always asked when I come to these conferences, tell me the sexy sector to get into right now. Tell me the hottest, latest theme to get into. So if this was 10 or 11 years ago and somebody asked me that question, like the right answer would have been apparently auto body repair shops. And if anybody actually came up with that, you know, I'd eat my hat, because nobody would have come up with that as the hot sector to get into. But it literally was. It was the best company to buy in Canada over the past 11 years. Now, we recommended this company 11 years ago this month at $2.10 or $2.30. Now, it's paid us around $4 in dividends over that time, and it trades at $180 today. So when this was done, I think it was 175. So it's around 8,000% now that it's gone up. So just in real dollar terms, 10 years ago, invest $20,000 in this company. It's worth $1.6 million today. So that can show you what can happen in your portfolio. Now, this is the absolute, literally best case scenario, the best stock you could have bought, but it gives you an example of it doesn't have to be the latest hot trend to make you money over time. We haven't just recommended this company once. We recommended it 25 times at different intervals, at different prices to clients over the last 11 years, and it's been an excellent winner. And all of those little red things at the bottom you see are distributions. Every month it pays us cash to own those shares as well. Now the funny thing is, a year ago, we did seminars too. We do seminars across the country. We have no lives. We don't see our families, so we just stay out on the road, I think. But we did seminars, and we were in a city, and we somebody came up to me after and she says, you know, I found most of the information really useful, but the stuff on Boyd, it's clearly all in the past, the returns. There's no way it can continue to go up. Why would you include that? And the stock was trading around $109 then. And I said, well, we look at it with fresh eyes. We think it offers good value. And she goes, well, it can't keep going up. It's just not going to. So I said, well, and she was from a city that I'll remain unnamed. It was Edmonton. So, and we said, like, it's not, you know, she wanted everything in the future. And we said, this business is just a great cash producing business. So over the past year, it's gone from 109 again to 180. You know, when you have a winner, continue to hold it long term and ride out those winners. So I'm going to ask for some quick more analyst or audience participation here. Does anybody know the worst performing sector in Canada over the past year? And we kind of alluded to this already, so I'll give you a hint. Anybody know? Cannabis, yeah. So it couldn't have been a hotter sector at this time last year, heading into legalization. It shows you, you know, what should I be avoiding? Possibly when everybody is talking about getting into that sector, and that is the hottest thing that you hear about in the markets, it's a time to be a little bit cautious in that segment. Now, this is one of the companies that we recommended this time last year, Expel. Again, this couldn't be a less sexy business. They're in the auto business as well, but all they do is put a little tiny film on your vehicle aftermarket to prevent those annoying scratches and dings. So you can see it's been an absolutely tremendous performer over the past year and 2 years since we recommended it. Why? Because they've absolutely hit it out of the park in terms of their returns, cash flow. So cash flow is up fourfold, 400% essentially over the past 2 years. That is how you have the share price go up 733% over that period. And again, it's not a sexy business, but the returns to me are sexy in the portfolio. So now, how should you start? How do you start by investing in these good companies? Well, you can listen to our research. You can do that. Or you could just start looking at stocks differently. And I think we all know this, but look at a stock like it's a business, not just a symbol. It's really good advice, but we forget that. And you need to follow this advice in your portfolio. It's a very simple concept, but many investors forget it. If you look at stock, every time you buy a little slice of a business, when you buy shares in a company, it's an ownership in an underlying business. If you look at it that way and invest like an owner, you will do well over time. Now, I mean, people invest funny in the stock market all the time. You don't know how many times I've had somebody come up to me and say, I just bought 10,000 shares, or I put $10,000 into this company. I don't know what the hell they do, but can you tell me your opinion on it? You should probably know what that business does, or at least have an advisor who knows what the company does if you're going to put your hard-earned dollars into it. People invest in stocks in a strange way. Like if you were given $100,000, I give this example all the time, and you had to say buy a restaurant. They said, here's $100,000. You're going to buy a restaurant. That's going to be your business for your life. You wouldn't just look at that business and I really love the name, and then I'm involved with it, suddenly, boom. But people look at a stock chart going like this and they buy it. Or I love the name of global blockchain. I got to be involved with that business. Now, if you just went off the name and then later found out that it was a steakhouse and you're a vegan, it's probably not a good idea. But what would you do if you got that $100,000 and put it into that business? You'd probably ask, can I see your balance sheet? Can I see your cash flow statement? Do you have money in the bank? Do you have a bunch of debt? Can I see your location where you are? Is there good growth around that? Is there a community that actively comes to your restaurant? But you look at the financials of the business to see if there was cash flow coming in so you could make money over time. It's the exact same thing when you buy a stock. You look at it like you're buying a business. You're buying a little slice of that business. It will serve you well long term. Profitability from current operations should be minimum criteria for long-term investment. Now, you want to speculate in something, that's your speculative part of your portfolio. You want to invest in profitable businesses that will allow you to sleep at night. It's hard enough in the financial industry to make money when you do it the right way. If you do it the wrong way, the odds will be stacked against you. Now, the financial industry, when they construct portfolios for you, we believe it's a broken model. Now, broadly, they sell you on diversification. You must own a broad array of securities. We don't believe in that strategy. I mean, we believe on a strategy called focused diversification, but vast diversification is not good for your portfolio. The typical application of this diversification strategy, when you go into your big bank or your big bank advisor, they put you in between 5 and 20 individual mutual funds. You've over-diversified, you have an over-complex portfolio, heavy with equities that you don't need to beat the market long term. And why? Well, if you look at this chart, this is from Efficient Market Hypotheses. Finance people like us love to look at this. What it essentially is telling you is you put any more than, it's really actually under 20, but any more than 20 stocks in your portfolio, and you absolutely have no benefit from diversification. Now, what you don't want to do is have 2 or 3 stocks in your portfolio, even if there are high conviction stocks that we've researched over and over again and we've crossed all our T's, dotted all our I's. You don't want to invest in the one company because you have too much company specific risk. I'll give you an example of that. You bought Tesla, and it's a very CEO driven, Elon Musk driven company. If heaven forbid Elon Musk was to pass away a couple of weeks after you bought that company, that is company specific risk. It's probably going to hurt that business. You may have done all the research you had in the world, but you have an event that you cannot factor into your research, and it's going to hurt. Now, if that's one of 20 stocks in your portfolio, you can diversify away that company specific risk. You don't need 50 stocks though, because then you've just bought the market, and like I said, you're going to underperform due to the fees that you pay in your portfolio. Now, but why does the industry do this? Why do they over diversify you in your portfolio? Well, one of the main reasons is the fees they can charge you. But I think Warren Buffett's quote on this is great. Diversification is protection against ignorance. It makes little sense if you know what you're doing. Most advisors say that diversification is for your protection. We believe it's mainly for their protection in your portfolio. If Warren Buffett puts his money where his mouth is all the time, but there was a study several years ago done on his multi-billion-dollar portfolio outside of Berkshire Hathaway, his massive holding company. It's multi-billion that I'm talking about today. 70% of that portfolio was in 8 stocks. So he does his research and puts his money where his mouth is in individual great stocks long term. That is what we try to do for our clients. There is one area, this is an aside, there's only one area. Warren Buffett's brilliant, we follow him, he's a tremendous investor. There's one area where we have a slight advantage over him in the market, and there is literally only one area you would have an advantage over him, and that is buying small companies. He is too big to buy even a Boyd, which is like a $5 billion market cap now. When we recommended it had a $10 million market cap, if you can believe, but he's too big. It doesn't move the needle in his portfolio. When he started off, he was buying smaller companies, and he was literally crushing the market at like 40, 50% in his returns. You can buy before a big behemoth like Warren Buffett can buy these little solid great companies, the companies that he would like to buy if he had less money today. And when he could employ less money, that's when he really crushed the market. So that's your advantage, because you don't have many advantages over him. Our solution to how to construct your portfolio. Take control of your portfolio. Create your own simple equity mutual fund, or your own fund yourself. Doesn't even have to be a mutual fund, but your own simple portfolio. How many stocks to own in it? We employ a strategy called focused diversification. So like I said, 10 to 25 stocks. For example, if you had 100,000 and you were going to do 10 stocks, you're going to equally weight 10%, 10% each, so 10,000, 10,000, 10,000. Select from a variety of sectors. What you don't want to do is buy 50% of your portfolio in the energy sector, for example. You're not going to get that through our research. We strategically buy from different sectors where we can find value, so you're going to get diversification. But if you're going to do it yourself, do it from multiple geographic regions and sectors. Build that portfolio over a 6 to 18 month period. I think one of the things traditional advisors do is you go to your advisor and they instantly put you into 5 or 10 mutual funds on one day. You bought the market on that day. If there is a correction and you buy it over 6 to 18 month period, and you've started 6 months in, at least the other half of your portfolio will be bought when the markets are more on sale. Trying to time the market is a fool's game from our perspective, though. That's the best strategy to use. Why small caps? This is outperformance over the long term. I'm going to start going fast so I can get to the companies here. But they've outperformed over the long term. It's a 3% difference over the 88 years. It makes a monumental difference in your portfolio the long term. This is another study. It was done small cap value stocks, more akin to the companies that we recommend, versus large cap stocks in the US. So 10,000 invested in those large cap stocks in 1926 would have given you 10 million by 2004. 10,000 invested in small caps, those value-oriented companies, 1 billion by 2004. I'm no mathematician, but I'll take the billion over the 10 million. So let's look at, finally, this is basically what I talked about. If Warren Buffett was going to look at small companies, what would he look at today? He was asked. smaller companies that Berkshire Hathaway can't even invest in today. This is the reason that one of the reasons why we look in that sector, where we think we can add value from our research. First company I'm going to recommend today, I recommended here last year. We recommended to clients just in May of 2018 at $3.85. Doesn't pay a yield, $365 million market cap. What do? They help save the healthcare system in the US a ton of money. Why? Because there's 11,000 people every day qualifying for Medicare over the next 19 years. The industry needs to cut costs and save money. They bring vents on patients into the home, as opposed to putting them into the hospital on an incubator. It saves money for the system, and it's great value. What does it trade at right now? $9.02. Why do we like it? Strong cash flow, just like we talked about. Great valuations. We think the fair value right now is around $12, so about 30% higher than it is right now. That is a conservative estimate. We like the business. This company, geothermal company, Polaris, what do? Operating in Nicaragua and Peru. Pay you about a 6% dividend yield. We think the fair value on this is somewhere in the range of, let me see here, somewhere in the range of $17, trades at around $13 right now. Growth at a reasonable price. So it's a good, solid business, and we'd buy it at these levels. It plays on the industry of renewable energy. It's a sector that is very much needed. That's why we highlighted it here today. Great, solid business, good, solid cash flow. This is a water technology company, one of the only pure play companies in Canada. We'd buy it at these levels because we think it's worth around $1.65 right now, and it's trading at $1.18. That would be a conservative estimate. I'm going to have to leave it there for you today. Those are the 3 stocks I recommend. If you want to talk to me, we'll be back at our booth after this. Have a great day, guys. Thank you.